Mutual funds. I got a really interesting comment yesterday from a viewer who said something along the lines that she didn't realize that people invested in mutual funds anymore. I mean, with the rise of ETFs, exchange traded funds, she thought that all the money was going towards passive investments in exchange traded funds. I will tell you what I, as a financial advisor, think of mutual funds. Stay with me. So, to bring everyone up to speed, exchange traded funds are basically a basket of stocks and bonds, or stocks or bonds, that are put together and are passively managed. And when I say passively managed, there is no fund manager that is in charge of that basket of stocks and bonds. So if a stock goes really down, if there's a problem in a sector or industry or overall problem with the market, no one is going to go into an ETF and adjust that portfolio. You basically are just along for the ride. Some of the benefits of exchange traded funds is that exchange traded funds typically have lower overall overhead costs than a mutual fund. Exchange traded funds also trade on a day-to-day, moment-by-moment basis because it depends on the stock price that is in that basket of stocks and bonds. So I can go today at this moment and trade and know exactly what I'm trading on with an exchange traded fund. Now, some of the drawbacks of exchange traded funds: during periods of market instability, no one is going in and changing out the funds in an ETF. And I've seen some ETFs take serious batterings in years like 2022, where it made sense to peel back on some sectors and some bond funds, but no one was going into an ETF and actually doing any of that work. A mutual fund, on the other hand, is a basket of stocks or bonds, or stocks and bonds, that are actively managed by a fund manager and or his or her entourage. Now, the mutual fund typically has higher overhead costs because someone has to pay the cost of that fund manager. Mutual funds, some of the drawbacks of mutual funds is that if I trade it today, I won't know until end of day what the market value of that trade is. Also, one benefit of a mutual fund, I can go in and put in $100 to most mutual funds and invest it immediately, whereas with ETFs or other funds or stocks, you have to buy it at the particular stock price. Another issue with mutual funds is that they tend to put off capital gains at the end of the year. So the fund manager and his or her entourage is in that fund throughout the year, buying stock, selling stock, trading bonds, etc. And all the while, that is generating capital gains. So you can hold a mutual fund for a long period of time and never trade on it, and yet still have to pay taxes on the capital gains each and every year. So I feel as though there's been kind of a demonization of mutual funds surrounding the potential cost of mutual funds. And I'm really well versed in the world of ETFs and mutual funds, and I will tell you this as a professional opinion as a financial advisor. There are mutual funds out there that are not worth the overhead and not worth the cost. There are some rock star performers in the mutual fund space that are well worth the cost, and that the gains or the excess performance of market standards well justifies the cost of investing in the mutual funds. The trick is you pretty much have to work with a professional to find those mutual funds, and you have to do some of your own research. Now, some financial advisors basically have to sell within a certain fund family or have a limited list of mutual funds that they can sell. The problem with that is it doesn't give the financial advisor opportunity to look at the full universe of mutual funds. It really narrows what we can select from. And there may be some great rock stars in that list, or maybe not. If your financial advisor has to sell from one fund family and that's it, it's like trying to play a concerto on the piano in one octave. You really have to have access to hundreds, if not thousands, of mutual funds to really be able to pick out the star players and to be able to put them together to make a portfolio that is risk adjusted and can give the returns that a client needs. So if you're thinking about mutual funds and you are working with a financial advisor, you do want to ask how they are compensated. Sometimes a financial advisor can be compensated through the mutual funds, and if so, you want to know that. So if a financial advisor is recommending a mutual fund to you, you want to know A, how that financial advisor is compensated, and B, what are the internal fees associated with that mutual fund. You also want to know what investments are held in the mutual fund. Another problem I've had with mutual funds, and this could potentially be a problem with ETFs, is my environmentally, socially conscious investors. Well, with a mutual fund, it's basically a basket of stocks and bonds. There may be a share or two of Philip Morris or Boeing or some company, Nestle, Coca-Cola, some company that socially conscious investors have objection to that may be part of the portfolio, or the fund manager may make part of the portfolio over time, and I wouldn't really have any knowledge of them doing that. So sometimes for socially conscious investors, it makes more sense to tilt towards a socially conscious mutual fund that has certain parameters around what can and can't be invested in versus just investing in general mutual funds. So let me talk a little bit on how mutual funds can really benefit people in retirement. This does take some planning, and it does take probably work with a financial advisor to identify the mutual funds that are really worth their weight and can really enhance your portfolio in retirement. So first things first, when a client comes to me and we're preparing for retirement, typically we're making some changes to their portfolio. Typically it's taking down the risk tolerance. And during that time, we're taking a look at their holdings, and we may be tilting it away from a higher risk growth strategy to more of a growth and income strategy. And one thing that I can say to a client that we're restructuring their portfolio is we have a conversation about the mutual funds, and I take a look at their mutual funds and to see and understand the capital gains that is typically put off by this mutual fund along with the dividends. Now, one thing that people really do appreciate is that with these mutual funds, the end of the year capital gains typically come in November, December. Instead of having those mutual funds reinvest as they do for most people right now, what I can do is to have them pay out to the client, and that just becomes part of their payment structure for the year. Now, I'm very cautious about turning on the capital gains payout towards the end of the year. If it's a younger retiree, maybe someone who is like 55 or anyone who's under 65, I'm a little bit reluctant to do it. Whereas the older the client is, the more likely I am to say, sure, go ahead, have at it. Reason for this is basically when you take the capital gains, rather than reinvesting them, you are stripping out part of the growth. And for someone who is younger, let's say a retiree who is 55, growth may still be really important to making that portfolio last for the next 35 years of that person's life expectancy. Whereas if somebody is 65 and older, let's say the person is 70, they have another 20 years life expectancy left, we may be able to get away with start whittling down the growth prospects of the portfolio and turning it more into income at that point. So one thing I look at in taking capital gains on a mutual fund portfolio is the client's age. Now, in terms of an individual brokerage account, mutual funds capital gains are taxed the year that they are earned, not the year that they are taken. So if the person has owned the mutual fund forever or owned mutual funds for a long time, it shouldn't make that much of a difference in their tax bill. But if this is something new and different, they've never had a mutual fund before, it's something that I have to carefully explain that it will impact their taxes for the next year. So the average capital gain on a mutual fund, people ask me what the average capital gain on a mutual fund is, usually somewhere between 5 and 7%. There are some mutual funds that do not pay out capital gains. That means the fund manager hasn't done much trading or any trading that year, but it is very rare to run across a mutual fund that doesn't have some form of capital gains. But it's typically 5 to 6% of the NAV, the total value of the mutual fund. So that means if you have $100,000 in a mutual fund and it's 5.5% return, that's an extra $5,500 a year. And that is apart from dividends. So the fund may be receiving dividends, and in addition to that, you receive an additional $5,500 in capital gains at the end of the year based on the trades that the mutual fund manager made throughout the year. So another question that a client had, or someone had in the comments section, is about mutual funds versus ETFs. I think there has been this collective consciousness that ETFs are automatically better because they're cheaper and they have less overhead. No, if you talk to a financial advisor, we will tell you that in some cases, ETFs are better because of the overhead. I'm looking at a mutual fund and the performance really doesn't justify the cost ratio to pay for the fund manager and his or her entourage to manage this, you may be better off with an ETF. However, mutual funds that are in maybe the top quintile, maybe the top 20% of mutual funds, it's well worth paying that fund manager and his or her entourage to manage that fund. What I'm looking at is performance. I'm looking at the cost. I'm looking at who the fund manager is. If the fund manager has been working in the industry a year, that's a bit different than someone who's been a fund manager for 20 years. I'm looking at the holdings. I'm looking at the trades that have been made over the past several years in that particular fund manager's portfolio. And, there are ratings agencies, and you have to take the rating agencies with a grain of salt. Things like Morningstar, take it with a grain of salt, but can give you some indication whether this mutual fund is a top performer or not a top performer. So if you listen to other financial gurus like Dave Ramsey, they give you like a very nuanced response to whether mutual funds are worth it. And Dave Ramsey is actually right. I do use mutual funds in my clients' portfolios. I own several mutual funds myself. I've done a lot of research on these mutual funds. They are top performers for myself and my clients. I rarely trade the client out of a mutual fund once I find a good mutual fund. Reason being, mutual funds do close. So if you trade out of that mutual fund, you may not be able to trade back in or even trade within that area of the fund family anymore. So I'm very cautious in terms of taking people out of well-performing mutual funds. You basically have to build a case that you shouldn't own that mutual fund anymore. And usually the answer is no, we're going to hold on to that mutual fund. It's a good performer and it puts off good returns and good capital gains. So there you have it. There are my thoughts about mutual funds, capital gains, and how they relate to retirement. Tell me what you think about mutual funds. Tell me what you think about capital gains. And if you found this information useful, please like, please share, and please subscribe.